Welcome to the deep dive. Today we're digging into a pretty detailed weekly brief from JP Morgan Asset Management. It's dated July 28, 2025. Our plan here is simple. Cut through the noise, pull out the really crucial stuff, market moves, economic forecasts, give you the insights without you having to wade through everything.
Exactly. It's about taking all this market data, which can seem overwhelming, and sort of synthesizing it. We want to find the patterns, connect the dots for you, so you understand not just what's happening, but crucially, why it matters for, your view of the global financial picture.
Okay, let's get into it then. The brief starts with this thought of the week, and it goes straight for gold, literally. It points out this, frankly, stunning rally. Gold's up around 30% just this year.
And over 80% in the last 5 years?
Yeah, hit new highs. In that kind of move, it definitely makes you sit up and take notice.
Oh, absolutely. And the brief connects this renewed interest in gold to a few specific things happening right now. We're talking heightened geopolitical risk, definitely. Then there are these growing worries about the U.S. fiscal situation, debt and deficits. And on top of that, quite a bit of speculation about the dollar, its future strength.
So it's like a perfect storm for gold.
Kind of, yeah. The brief suggests these are very specific anxieties that maybe traditional assets aren't quite covering off for investors right now, a sort of modern flight to safety.
Right, but here's where it gets interesting, because the brief doesn't just leave it there, does it? After highlighting these big gains, it sort of pumps the brakes a little, makes you wonder, okay, what's the catch? What should you really think about before, jumping on the gold bandwagon? Beyond those headlines.
That's a really important nuance in the brief. Yes, gold looks shiny, but they point out some pretty significant downsides or maybe considerations. First off, it's volatile, highly volatile. Prices can swing wildly. Second, unlike stocks or bonds, gold generates zero income. No dividends, no interest payments. That can be a real drag over the long term.
Right, no yield.
Exactly. Third, its reputation as an inflation hedge. The brief says its actual record is, patchy. It hasn't always delivered on that front. And maybe the biggest warning sign. Gold has gone through really long stretches, years even, where its price basically went nowhere. Stagnation.
So putting all that together, the impressive rally, but also these serious warnings, what's the final word from the brief? How should you think about gold in your portfolio? Is it a buy or more like a handle with care?
It's definitely nuanced. The recommendation isn't a simple yes or no. The brief seems to say, look, gold's recent run does confirm its value as a hedge, specifically against geopolitical risk in this current climate. But, and this is the key part, it works best when it's part of a mix, paired strategically with other real assets, especially ones that do generate income. So it's about diversification against certain unique risks, but it's absolutely not the whole answer for a portfolio. Less gold rush, more strategic sprinkle, maybe.
Strategic sprinkle, I like that. Okay, so if gold is playing this sort of complex hedging role, what else should we be watching out for? The brief has that week ahead section, right? Kind of a heads up on key economic events coming down the pike. These are often the things that move markets.
They really are, and this coming week looks packed with potentially significant data points. Okay, so on Tuesday, we've got eyes on the U.S. JOLTS report, that's job openings for June, gives a sense of labor demand, and also U.S. consumer confidence for July. How are people feeling about spending?
Right.
Then Wednesday gets really interesting, especially with central banks. We get Q2 GDP growth figures for the Eurozone. And importantly for the U.S., remember the prior U.S. reading was negative, minus 0.5% quarter on quarter.
Yeah, that was a worry.
So that U.S. GDP number will be closely watched. But the main event Wednesday, definitely the U.S. FOMC rate decision for July.
The Fed decision. That feels huge, especially with those mixed signals lately.
Yeah.
Does the brief hint at what JP Morgan expects, or maybe just the tension around it?
It doesn't really have a specific forecast for the decision itself, no. But it definitely highlights how critical those GDP and jobs numbers are for that decision. If we see another negative U.S. GDP print, combined with whatever the JOLT test data shows, that could certainly influence their thinking on rates, put pressure on them.
Makes sense. What about the rest of the week?
Let's see. Thursday, we get China's MBS PMI. That's a key manufacturing indicator over there. Then the Eurozone unemployment rate for June. And another central bank decision, the Bank of Japan rate call for July.
Busy day.
Yeah, and also on Thursday, a big one for the U.S., core PCE inflation for June year over year. That's the Fed's preferred inflation measure, right? So super important for their policy outlook.
Got it. Core PCE.
And then Friday kind of rounds it all out. We get Eurozone inflation numbers, both headline and core, for July, followed by more critical U.S. data, the non-farm payrolls report for July, plus average hourly earnings, that's wage growth.
Jobs Friday, always a big one.
Always. And we also get the U.S. ISM manufacturing PMI on Friday, too. And, all these pieces are connected. Strong jobs or sticky inflation could push central banks towards keeping rates higher or maybe raising them again, which obviously affects bonds, currencies, everything. It's a whole interconnected web.
Definitely a week to pay attention to. Okay, let's shift gears slightly to the market statistics section in the brief. This gives us that snapshot, right? How things looked across different assets or regions leading up to July 25th really helps get the market's current pulse.
Yeah, and looking through these numbers, it paints quite a nuanced picture, actually. In stocks, for example, MSCI China really stands out. Up, 26.8% year to date, and almost 50% over the past year. That's huge.
Yeah.
But broader indexes look pretty solid, too. The S&P 500 up 9.4% year to date, nearly 20% year on year. The global MSCI AC World showing similar strength. And it's interesting drilling down into sectors, too. Like, healthcare had a strong week, up over 3%, but it's actually down over the past year. Shows some rotation happening.
Okay, so strong equities overall, especially China. Does that positive feeling carry over into bonds? Or is that a different story?
That's a great question. It's a bit more mixed in bonds, I'd say. Global investment grade spreads, basically the extra yield companies pay over governments, they tighten slightly, down 3 basis points to 80. The brief suggests this might mean investors are getting a little less worried about companies defaulting. A subtle positive sign, maybe.
A bit less worry there.
Meanwhile, government bond yields, the 10 years, are kind of varied. U.S. at 4.38%, Germany lower at 2.72%, Japan way down at 1.60%. The brief notes these levels reflect, different economic outlooks and expected central bank paths in each region.
Right, and commodities. We talked gold.
Yep, gold at $332 an ounce with those big gains we mentioned, 26.9% year to date, over 40% year on year. But then look at Brent crude oil, around $69 a barrel, actually down 7.4% year to date. So a real divergence there.
Interesting. Okay, what else? Currencies? Volatility?
Quick look at currencies. Dollar euro around 1.17, dollar yen at 148. Just gives you a sense of those key levels. And volatility, the VIX index, the fear gauge, it's sitting at 15.
That seems low.
It is quite low, yeah. Notably lower than the 18 it was a year ago. Suggests markets are relatively calm, maybe even a bit complacent. The brief kind of implies this calmness is worth thinking about, especially when you look at some of the underlying economic data points.
Yeah, that's a good point. The VIX might seem calm, but what about the actual economic growth and inflation numbers? What did the brief report there?
Well, that's where the mixed picture really comes in. For the U.S., the reported GDP was that negative 0.5% figure we mentioned, while CPI inflation was 2.7%. Contrast that sharply with China, GDP reported at 4.5%, but CPI inflation barely registering at 0.1%. Very different dynamics.
Wow, yeah, very different. And valuation, did it touch on that?
Briefly, yeah. It notes the S&P 500's forward PE ratio is at 22.7, which, the brief suggests is pretty elevated. Could mean valuations are stretched, or maybe just that investors still expect pretty strong earnings growth ahead, despite some of those headwinds like the negative U.S. GDP.
So pulling all those stats together, what's the bigger story they tell?
I think the narrative is one of ongoing shifts. We're seeing pockets of real strength, like in Chinese equities and parts of the U.S. market. Bond markets are maybe showing slightly less stress on the corporate side. The low VIX suggests investors aren't panicked. But the hard macro data, like that U.S. GDP dip or the very low inflation in China, points to these underlying currents and divergences that definitely need watching. It's a dynamic situation. Things are definitely still evolving.
Right. So, okay, let's just quickly wrap up the main takeaways from this deep dive. We've really looked at gold, its big run-up, but also the important warnings from the brief, crucial context there. We flagged the key economic events coming up this week. Fed, GDP, jobs, inflation, lots to watch that could move things. And we've gotten a feel for the market's pulse right now through those specific stats across stocks, bonds, commodities.
And thinking about all that, it really raises an important question for you, the listener. How can understanding these connections, how gold relates to risk, how data impacts central banks, how different markets are performing, how can that help you, filter the daily noise and focus on what really matters for understanding the bigger economic trends?
Exactly. And maybe one final thought to leave you with. Given everything we've talked about from the brief, the impressive performance of some assets like gold, but also the volatility underneath, the economic shifts happening, how might you adjust your own perspective? How do you get better at telling the difference between just short-term market chatter and the signals of those deeper, longer-term trends? Something to think about.